Great. Yeah, everybody could ask all the questions before I went. That was perfect. Thanks for having me. Honored to be here. And my question is very similar to Lynn's, but a little bit different framework. Given that Bitcoin and MSTR volatility is near multi-year lows, and strategy has historically targeted a 20 to 30% leverage ratio during the convertible bond era, how does strategy team now think about future volatility, leverage, and do you anticipate revisiting your leverage framework, reflecting the difference in preferred leverage characteristics and understanding the goal of retiring the convertible bond dated liabilities?
What I would say is 20 to 30% leverage is appropriate if you have a mix of bonds or mostly bonds on your balance sheet. But if you eliminate the bonds, which come due for cash, if they're not in the money, and you replace them with a preferred equity, then clearly it's reasonable to go beyond 20 to 30%, and you could look at 30 to 50%. I don't think it's appropriate to say we've changed that target range now because we still have $8.3 billion of convertible bonds. But what I think is over time, as we go to a preferred credit strategy, then the world opens up and we can take on more leverage. And the amount of leverage we can take on will be a function of the credit instruments. If we go to pure, for example, if you were non-cumulative credit, you could even take more leverage than cumulative credit, right? So the nature of the credit instrument will determine that, and then the volatility of Bitcoin, will also determine that. If you're at 50 vol, you have a different view toward what that should be versus at 30 vol. So I think those will be part of our calculus each year for the next 10 years, and we will evolve. I don't know if we'll evolve quarter by quarter, but we'll probably evolve year by year. We generally do. And as for the volatility in the stock, I think the volatility is going to come back. We're going to see a lot more performance and volatility in the MSTR stock for a couple reasons. One, the equity guidance we gave, if we take a more programmatic discipline view toward using the MSTR ATM, then I think there'll be more volatility in the equity because now there'll be more value in out of the money calls and things, right? Like if you thought the company was going to sell MSTR at $500, you probably wouldn't want to buy a $600 call option. Right, so I think that our equity guidance will probably be very positive for the options market and for the shorter term traders that have an impact. And then I think that the acceleration, the transformation from bonds to preferred will also have a positive impact. And then I think the acceleration of our credit strategy via the preferred ATMs will have another impact. And I think the wild card here, Jeff, is I think that stretch is our iPhone moment. I really think that if you think about products we have, if I literally show people that the convertible bonds are mispriced and trading 40% cheap, and then I show you there's an 800 basis point unjustified spread premium, and people blink and nothing happens. And then nothing happens because nobody can buy that stuff. Right? So the convertible bonds clearly were not our iPhone. And on the other hand, Stride, Strife, and Strike are breakthrough revolutionary instruments, but they're complicated and they're long duration. And if I saw a retiree, who said, what do you have? And I said, well, you can get 5% yield or 5% more than your bank account if you buy Strife. And if it was trading 122 and then it dropped to 116 the next week, the person would be really pretty, anxiety ridden because, having 5% or 10% change in the principal when you're getting a 5% credit spread isn't really a consumer thing, right? That's too much of a roller coaster for them. So I think that the idea of a consumer product is, what's the product that you can offer anybody any day of the week for the next 10 years, regardless of what the stock is trading at? If the stock is trading at 10 MNAV or 1 MNAV, right? That's a MSTR equity roller coaster. And if Bitcoin all of a sudden rages up to 500,000, and someone's saying, well, should I buy this instrument or not? It's like there's a roller coaster. But if I'm saying that we've stripped down to a 1 month duration and it pays 500 basis points above your bank account, it's always going to be trading, hopefully, in our range. We're going to hope and expect it trades around to 100 plus or minus a quarter or something, and it's always paying more than your bank account. And if people see that and they see liquidity, then in theory, I don't know why you can't sell. If you walk down the street and you asked 100 people, do you want high yield bank account? 99 of 100 say yes. And if you said, do you want this, 100-year long Bitcoin backed, senior, junior instrument, 1, 2, 3, 5 out of 10, or 5 of them might try to figure it out. And I know that's a long-winded answer, but the point is, if there's infinite demand for stretch, if it works, right? And we can't declare that, we can't declare it seasoned until 30, 40, 50 days after we've launched it. But if stretch actually, hits its par and it trades with low volatility, then you could, in theory, sell infinite, $100 billion of it, $200 billion of it, right? You could use that to have any amount of leverage you wanted. And then the question of how much leverage do you want is really going to be a question of how rapidly does Bitcoin price appreciate and with what volatility, and then how rapidly do we roll out of the convertible bonds, and then how rapidly do we get embraced by institutional investors and credit rating agencies. And those are all things that we don't know in the future. But if you take all that in its entirety, wouldn't you think that the performance and the volatility is coming back into the equity? We got a plan for it, right? We got 3 or 4 different ways to get there, and maybe time will just do it for us.